Welcome back to the Deep Dive. Today, we're going to try and look behind the curtain. And I don't mean the curtain at the theater. I mean the heavy velvet drape that separates the retail trader, us with our apps and our hopes,
Right.
from the institutional giants who actually, well, run the show.
It is a bit of a Wizard of Oz situation, isn't it?
It really is. Because whenever I try to picture what a winning trader looks like, someone who is truly beating the market consistently, my brain defaults to Hollywood.
Mm-hmm.
I picture a guy in a tailored vest, standing in front of, like, 6 monitors, shouting into a phone, maybe with some scrolling green code reflecting in his glasses.
The Wolf of Wall Street meets the Matrix.
Exactly. We assume the secret sauce is flashy. We think it involves some proprietary complex software with a magic buy button that only the elite have access to.
But that's not what we're talking about today.
Not at all. The source material we have today, it's a technical breakdown from the quantitative analysis channel Quant Labs, recorded just recently on January 24th. It completely flips that narrative.
It really does. It suggests that the reality of high-level trading is significantly more boring than the movie version, but it is also infinitely more dangerous for the average person trying to replicate it.
Yeah, dangerous is the word. We are going to be digging into the raw plumbing of the market today. The source isn't looking at the pretty charts you see on Robinhood or TradingView. He is looking at the raw data logs, specifically something called C features.
From a high-end data service called Rhythmic.
Right.
And just to frame this for everyone, Rhythmic isn't something you download from the App Store. This is low-latency, unfiltered access to exchange data. It's the fire hose.
It's the fire hose, yeah. And the mission for this deep dive is to unpack what is actually happening in the milliseconds of the market. Because the source's main thesis is actually kind of insulting, but in a helpful way.
How so?
He argues that a huge chunk of the data traders obsess over is actually useless for 99% of us.
I wouldn't say useless, I'd say deceptive.
Deceptive.
It's worse than useless because it tricks you into thinking you see a pattern when you don't.
Okay, that is a heavy accusation. So if I'm sitting there spotting a trend, thinking I'm smart, this source is saying, I might just be looking at noise created by the bigwigs to confuse me.
Essentially, yes. That's the argument. We're going to explore how multi-billion-dollar firms use what looks like valid market data to basically create noise, churn the water, and hide their real moves.
So if you've ever wondered why the market zags when your technical analysis textbook says it should undoubtedly zag, stick around. We're going to explain the difference between high-frequency trading opportunities, which are for the machines,
and what a mom-and-pop investor can actually execute.
Okay, let's unpack this.
Let's do it.
So to set the scene, the source conducted an experiment. This wasn't a year-long academic study. This was a look-under-the-hood snapshot. He monitored a few hours of raw data flow between major instruments, specifically the NQ, which is NASDAQ futures.
The tech-heavy index, usually considered the volatile, fast-moving one.
Right. And the ES, which is these S&P 500 futures. He also looked at oil, or CL.
Okay.
But the real story here was the comparison between the indices.
Okay.
Now, he wasn't looking at price. He was counting occurrences.
And we should probably pause and ELI5 that term occurrences.
Please, because to me, an occurrence just sounds like something happened.
That's actually not far off. In this context, he's looking at the C features, the raw code logs. An occurrence is the heartbeat of the algorithm. It's not just a trade execution.
Oh.
It's every time the system analyzes a price tick, updates a bid, sends a query, or checks a logic gate. It is the digital exhaust of the trading engine.
So if the engine is revving hard, you get more occurrences.
Exactly. He's measuring the RPMs of the market, not just the speed of the car.
Got it. So here's where the data gets weird.
Yeah.
He compared the volume of these occurrences between the NASDAQ and the S&P 500. For the NASDAQ, in this short window, he logged about 48,000 occurrences.
Which is a lot of chatter.
A massive amount of data. But then he looked at the S&P 500, specifically the ESH6 contract, and the volume there. It was nearly double.
Double. So we're talking over 93,000.
Implied to be, yeah, over 93,000.
That is the first big disparity?
Oh, hang on. I always think of the NASDAQ as the crazy high-speed casino. Why is the S&P 500 the boring index of stable companies generating double the algorithmic noise?
Because that's where the liquidity lives. The S&P 500 is the elephant in the room.
Ah.
It's where the massive pension funds, the sovereign wealth funds, and the structural hedging happens. The NASDAQ might have wilder price swings, but the S&P 500 has the depth.
So double the occurrences means double the activity.
Correct.
Well, playing devil's advocate here,
Mm-hmm.
isn't that good? If I'm a trader, don't I want to go where the action is? If the S&P has double the fish, shouldn't I be casting my line there?
You would think so. That's the logical assumption. But this is where the source makes a critical pivot. He says, yes, there is double the opportunity, but that creates double the noise.
Define noise in this context, because usually data is information.
Not at the speed. Imagine you are trying to listen to a song. The NASDAQ is playing the song loudly. The S&P 500 is playing the song, but there are also, I don't know, 3 jackhammers and a jet engine running in the background.
Okay, that's a headache.
The data, those 93,000 occurrences, represents a fire hose. For a human being, or even a standard retail trading bot running on your laptop, trying to drink from that fire hose is impossible. Most of that data isn't price moving up because value went up. It's algorithms fighting each other.
So he's saying that for the average person, looking at that raw feed is actually detrimental.
It's a trap, and this leads us directly into the concept of the HFT trap.
Let's get into that, because this was the part of the source material that made me actually put down my coffee.
Chuckles, right.
The source starts talking about buy and sell signals. Now, in my simple mind, a buy signal is a good thing. It's the green light. It means get in now.
In a normal human time frame, yes.
But the analysis here shows signals being generated down to the millisecond. The source gives a specific example. He sees a buy signal on the S&P 500 futures based on a MACD indicator.
A very common momentum indicator, probably the most used indicator in history.
Right. He sees the buy signal, but then literally 3 seconds later, 3 seconds, there's a sell signal.
And that is the kill zone.
Explain that. Because fundamentally, the value of the top 500 companies in the U.S. didn't change in 3 seconds.
Yeah.
Apple didn't go bankrupt and then recover in the time it took me to sneeze.
No. So what are you seeing? You are seeing high-frequency trading, or HFT algorithms at work. Imagine you are a multi-billion-dollar firm. Your servers are physically located inside the exchange data center to minimize the time light takes to travel through the fiber optic cable.
We're talking Flash Boy stuff.
Exactly. For that firm, that buy signal followed by a sell signal 3 seconds later, that's a profit opportunity. They are scalping tiny, tiny discrepancies. They might make a fraction of a penny per share, but they do it millions of times. They get in and out before your screen even refreshes.
So for them, it's a valid strategy. It's just business.
It's their entire business model. But now, put yourself in the shoes of the mom and pop investor the source talks about, or even someone with a decent-sized account, let's say under $10 million.
Which is pretty much everyone listening to us right now.
Right. If you try to chase that buy signal, by the time your brain processes, oh, green light, and you click your mouse and your order travels over the internet to your broker and then to the exchange,
It's too late.
it's way too late. The algorithm has already switched to sell.
So I'm buying exactly when they are selling.
You are buying their trash. You are providing the liquidity for them to exit their trade. You are the bag holder instantly.
That is humbling
Yeah.
and honestly a little infuriating.
The source is very blunt about this. He says, for the retail investor, this high-speed data isn't information. It is garbage. It is noise.
But he goes a step further than just calling it garbage, doesn't he? He suggests this isn't just accidental market mechanics. He uses the M word,
Manipulation.
manipulation.
He does. And this is a controversial view, but it holds water when you look at the structure. These HFT firms know that retail traders are looking at these technical indicators. They know that if they paint a certain picture on the chart, a breakout, a volume spike, retail money will chase it.
So they are churning the water to hide what they're doing or to lure us in.
Both. It's called spoofing or layering in some contexts, though that's technically illegal. The mechanics of churning look very similar. They create a frenzy of activity, buy, sell, that looks like genuine market momentum to the untrained eye, but it's just algorithmic churning.
It's like a mirage in the desert.
It is. And if you try to trade it, you're just paying commissions and losing on the spread. You are playing a game of reflex against a computer that doesn't have reflexes. It has calculations.
The source asks a really poignant question here. What can a mom and pop investor do with this? And his answer is basically, not a whole lot.
Not a whole lot if you start at that level. If you try to fight them in the mud, you lose.
So, if the millisecond data is a trap and the S&P 500 is just a noise factory for the average guy,
Yeah.
what are we supposed to look at? Because the source didn't just stay in the weeds, he zoomed out.
He did, and this is the pivot point of the deep dive, I think. This is where we move from the millisecond noise to the macro. While he's watching these algorithms fight over pennies, he noticed significant macro warnings that were influencing the broader data flow.
He started talking about global liquidity fears. And he
Yes.
got specific. He started talking about the Bank of Japan, the BOJ. Now, I have to pause you here because I can hear our listeners asking, I live in Ohio, or I live in London. I trade the S&P 500. Why on earth does the Bank of Japan matter to my portfolio?
That is the right question. And the answer is something called the carry trade.
Oh, okay.
It is the invisible plumbing of the global economy.
Break that down for us.
Okay. Historically, for a long time, Japan has had extremely low interest rates, sometimes zero, sometimes negative. So, what do the big global banks and hedge funds do? They borrow money in Japanese yen because it's basically free to borrow.
Free money. I like that.
But they don't keep it in yen. They take that borrowed yen, convert it to dollars, and buy U.S. stocks, U.S. bonds, or tech stocks. They're using cheap Japanese money to pump up American assets.
So a lot of the money fueling the S&P 500
Mm,
is actually Japanese yen in disguise.
exactly. But, here's the danger the source highlights. The Bank of Japan is starting to intervene. They are worried about their own currency if they raise rates or if Japanese bonds yield more. That free money loan isn't free anymore.
And if the loan isn't free,
The big institutions have to pay it back. To pay it back, they have to sell the U.S. assets they bought.
which means selling the S&P 500.
Aggressively. The source warns that this could have a colossal impact on financial markets. He's talking about a liquidity drain.
So let me get this straight. While the retail trader is staring at a 1-minute chart of the S&P 500, sweating over a Mankey crossover thinking, oh, the chart looks bullish,
Right.
the Bank of Japan might be pulling the rug out from under the entire global economy.
That's the danger. The algorithm might give you a buy signal because of some microstructure setup, but if the macro tide is going out because of the carry trade unwinding, that buy signal is going to get crushed.
It really reinforces that you cannot trade in a vacuum. You can't just look at the lines on the screen.
No, context is everything. And he added another layer to this macro picture, crypto.
Right. Bitcoin and Ethereum.
He noted that UBS, the huge Swiss bank, is pushing these assets to their clientele.
Now, usually, crypto people cheer when they hear institutional adoption. Is that how he framed it?
He framed it as a signal of where the big money is positioning. It's part of the landscape. If you have the BOJ threatening liquidity on one side and major banks pushing alternative assets like crypto on the other, these are massive, slow-moving tectonic plates.
And these plates matter more than the millisecond ticks.
Exactly. The source is saying, don't get lost in the HFT noise. Look at the backdrop. Are bonds rising? Is liquidity drying up? That is what dictates the real trend.
This brings us to the solution. Because I think if we stopped here, the takeaway would just be the market is rigged, the Bank of Japan is scary, put your money under a mattress.
Which would be a prudent but very boring deep dive.
But the source offers a strategy. If raw buy-sell signals are just noise for us, what is the alternative? He mentions a concept called layering.
Layering is the key takeaway here. It's about not relying on a single source of truth. He's taking that raw market data, the volume, the flow, and he is layering it with news.
But not just scrolling through Twitter or reading the headlines on CNBC, right?
No, that's too slow and too full of opinion. He's talking about using AI.
AI seems to be everywhere these days. How is he using it here? Not to trade for him.
No, not to execute trades. He's using AI to analyze news feeds to find intelligent trading opportunities. Think of the AI as a bullshit filter.
A filter. Okay. How does that work in practice?
Well, we established that HFT firms can create fake volume or fake price moves on the chart. They can manipulate the price for a few seconds or minutes,
Right.
but they can't create fake news, at least not real economic drivers, instantly.
So if the price spikes up, the AI checks why.
Exactly. Imagine the S&P 500 jumps 10 points in a minute. The HFT algorithms might be going crazy, painting green candles everywhere. Your emotions say, FOMO, buy.
The train is leaving the station.
Right. But if your AI scans the news feeds and finds nothing, no earnings report, no Federal Reserve announcement, no geopolitical event, no Bank of Japan statement,
Then the move is suspect.
it's likely just noise. It's a fake out. The source argues that we need to use news as a confirmation filter. If the data shows a move and the news backs it up and the volume is there, now you have a high probability trade.
He calls this moving up a level.
That's the phrase. Stop looking at the microscopic level. That's where the sharks live. Move up a level where the trends are clearer, where the movements are driven by actual information, not just algorithmic games.
It's interesting because he explicitly mentions that for accounts under $1 million or even 10 million, This is the only way to survive. You have to confirm the theory using fee-based services and real news.
It's about asymmetry. The HFT firms have the speed advantage. They will always win on speed. They have better hardware, better location, faster code. You cannot beat them there.
So you have to compete somewhere else.
I have to compete on a different axis.
Which is
Context. They have speed. We have context.
context. I like that. It's a much slower way to trade, though.
It is, but it's a much safer way to trade. You are verifying the volume with the narrative.
It sounds like he's advocating for patience, which is the hardest thing for a trader to have.
He is. He's shifting from a reactive state chasing every tick, like a dog chasing a car, to an analytical state waiting for the data and the news to align.
It reminds me of a detective building a case. You have a fingerprint. That's the data. But a fingerprint alone doesn't solve the crime or prove guilt. You need a motive. The news is the motive.
That's a fantastic analogy. Without the motive, the fingerprint is just circumstantial evidence. And in trading, acting on circumstantial evidence gets you broke. You need the full picture before you commit your capital.
So let's bring this all together. We started this deep dive looking for the secret sauce inside the black box.
And we found it, but it wasn't the magic spell we expected.
No. The secret sauce isn't a magic indicator or a special software setting. It's raw data. But for most of us, that raw data is actually poison.
It's noise designed to confuse you. It represents the churning of algorithms, not the movement of value.
The real value is hidden in the S&P 500 volume, but only if you filter through the lens of real news and macro events like the carry trade unwinding or institutional moves.
That's the synthesis. You need the raw data to see the activity, but you need the macro news to understand the intent behind the activity. Without the news, you're just gambling against a supercomputer that knows your hand before you play it.
And we should remind everyone, of course, that this is based on the observations of one quantitative analyst, Quant Labs. This is his take on the market structure as of late January. It's a fascinating insight, but it's not financial advice.
Absolutely. It's one perspective, but it's a perspective that challenges the common retail trader mindset of just staring at charts all day and ignoring the rest of the world.
It really makes you question the game we're playing. I want to leave you with this thought today. If the smart money, the multi-billion-dollar firms, makes its cash by confusing the retail market with speed and noise, is patience the only true edge a regular investor has left?
That's a powerful thought. If you can't run faster than them, maybe you just have to wait longer than them.
Something to mull over before you open your brokerage app next time. Thanks for listening to the Deep Dive. We'll see you on the next one.
Take care.